All right, guys, what's happening? Jay here. This is SmartHelping.com. It's been a little over a month since the last financial model. Um, yeah, I haven't been this slow on new templates for about probably 5 years. I'm going to try and go on a little run here and see if I could get a whole bunch in. This latest one is for, well, it's a new business concept, but we're doing real estate. It's called neighborhood co-working pods. What does that mean? Well, people don't like to go into the office. There's also a lot of freelancers, so there's more demand for people to like get out of their own house, but they don't want to rent out an expensive office in an office building. Well, there's manufacturers that build these kind of pods that fit, usually around 8 seats worth of people. They have internet, seclusion, quiet, where people can just go and work. Now, the idea of this business here that we built a template for is people pay a monthly membership for access to their pod. And it's kind of like obviously rent, but it's recurring revenue. And the company obviously sets the price, and it can go up over time. I did some new things with price elasticity and utilization, essentially modeling demand changes. So I'm excited to show you how that's going to work because I've never done that before. But other than that, let's go through a quick look at each tab, then I'll dive into detail. So global control, there's a lot of stuff here with if you're raising money from investors, there's these things, but otherwise it's just general timing assumptions to start month, how long you want the forecast to be, up to 10 years, 120 months, exit assumptions, and then GP fees if this is a special joint venture where uh, the GP's collecting some fees and raising money and all that stuff. Build out tranches. This is where you're doing most of the work, deploying the tranches of pods, ongoing expenses, other startup costs, your monthly and annual pro forma, sources and uses executive summary, some visuals, and then we've got our joint venture distribution waterfalls if you get into that. Really, the most important uh, tabs would be the global control for your timing and exit assumptions, the build out tranches, and the monthly pro forma. That's where most people spend their time. Everything else is just a summary of what's going on those three tabs, basically. So, and also add additional summaries for joint ventures and doing things on top of essentially business cash flows. So, let's start back here with the build out tranches. So the way I developed this framework is you've got up to 60 tranches. They can be deployed, tranches can be happening at the same time. Each one has its own launch month, or they can happen over time. And each tranche, you have a number of pods you're deploying. You can define the seats on average each pod is going to have. The capex per pod, which will vary. And total, and again, this capex per pod could go down as you get more efficient at deployment. Um, and again, there you might want another tab or to detail out this capex somewhere, but the total capex per pod you just put in here, and this is your total capex. We've also got where did I put it over here? I think there's other costs at close that you can put in as well. Um, that those would not be subject to your financing, which is just going to apply to the capex. So that gives you enough flexibility to account for essentially any general financing strategy. Anyway, capex per pod, total capex, and then we have starting occupancy. And again, your starting occupancy might be higher as you build a brand and build out these pods, and it might be quicker to get to a target utilization as well. So here you can model that by defining how much time it takes to set up from your initial launch, or essentially the launch is kind of like the initial deployment month. It could be 1 month, 2 months, 0 months, probably at least 1 month though. Um, the months it takes you to hit your target utilization. And what we've done here is, let's see, so K minus H. So what I did to model demand, and you can get higher than the target utilization. There's a stabilized utilization, and you can also, because stabilized could be over 100%. It's possible to, like, maybe you rent out a pod for half a day. Somebody could pay for half a day, the other pays for another half. So there's kind of situations where it's possible you might have over 100% utilization of the existing seats or pods. And there's also a max uplift of price. So no matter how much higher, how high your utilization might go, you'll never raise the price above, a certain percentage of the initial base membership price. So this is new. I've not modeled in this way before, but I like it. So again, the setup time tells you how long from the initial launch to when you start making revenue. When revenue starts coming in, you then have a starting utilization or occupancy, so this percentage. Then you have a target utilization, so 70%, and it's going to take, we're saying 15 months to get to 70, so that gives you 0.7% improvement per month. And each tranche is dynamic on the model's timeline, so depending on when it starts here, it'll still follow these proper months dynamically, which is, you can see here on the M1 tab how all these things happen over time, and we sum them up on a monthly view. Okay. And then once you hit target, you can go over target. So depending on how far you are under or over the target utilization, you will see the pricing be under or over the base. And we also overlaid like an inflation, just an annual percentage growth rate of price on top of that. But you can still see, for example, I thought this was pretty interesting to model as well. Where do we do price? So we have price. We have price pre-inflation. So we start out at 380 on tranche 1. Even though your base membership price is 400, you're starting at 60% utilization against a 70% target. So what that means is you have a lower price than your base as you try to fill up, and then as you fill up, demand happens as time goes on. You start charging more on average per seat. And this is a monthly recurring revenue figure here. And the price elasticity, how high or low that change is defined here. So at 0.5, it's going to be higher. You can see, let's say I put this at first. So this is $380. If I were to put this to 0.2, you're not 392. So a smaller change from the base. If I were to put it at, 0.8, then it'll be really low, 368. Whereas at 0.5, we're at 380. So again, you could define this elasticity will define how far you go from the base based on where your actual utilization is over time against this target. And then this percentage defines the max you'll go above your base price, no matter how high your utilization gets. This was really cool. Again, first time I put this in a framework, and I think it's got a lot of use, so awesome there. We've also got some other ancillary income. You can say, maybe you sell day passes to the pods, so we can define a percentage of the unused seats. So, if you're at 60% occupancy, you have 40% of the seats, and we're saying there's, 8 seats per pod and 5 pods. So in this case, there's 40 potential seats that you can sell memberships to. You can say a percentage of the unused seats every month that get used that have day passes. So we have percentage of day pass utilization of unused seats, X percent, the price per day pass, and then ancillary revenue per member, ancillary revenue per day pass. So the regular members might have ancillary revenue from this, so buying coffee and so on, and there'll be a way to put in a margin on your ongoing expenses down here for the cost of goods sold percentage, so you can figure out how much you're making on that ancillary revenue. Same goes with the day pass ancillary. Now, one thing actually I just realized, one second. Okay, we actually just, quick update, I just unpaused the video. So we have to figure out how many days on average in a month the day passes are used for. For example, if you had, let's say you had 40 seats, say 15 seats were not used, so you sold day passes to those 15 seats. So in a given month, your revenue would be the day pass times the 15 seats times the number of seats that are actually utilized. That would be for one day. So you have to do on average for a month essentially how often are your day pass seats being used in a given month. So if you'd say half, because this utilization, the utilization of unused seats just tells you, okay, you've got 15 unused seats. Of those unused seats, we're saying 35% are used for day passes. Okay, that's 5 of those seats are being used for day passes. And is that every single day of the month? So, on Monday, 5. Tuesday, okay, another 5. Wednesday, 5. Um, if so, you have to do, well, how many on average, how many days per month are the day passes being used for a given seat? So it's a double layer there, so we have to put in a number. If you put in 15, that's essentially saying half the month. If you put in, 5, it's just saying, well, of those unused seats, 35% are using day passes, and that's happening, 5 days of a given of the 30 days in a month. So we just need to know how often in a month people are using the day passes that are available with unused seats. So that affects revenue for day pass ancillary. It also affects revenue, day pass revenue itself. Okay, so that's implemented. Just did that really quick. All right, so day passes, because this day pass is for one day. It's not for like you pay for a month, and I can, then it'd be a monthly pass, and you might as well just be selling monthly, so it's a membership price. So this is just for a single day, and these prices are arbitrary. You'll have to go in here and set your own prices and based on your strategy and see what makes sense as far as your capex, your revenues, expenses, and what returns look like based on adjusting all these different things. That's the point of the model. Okay. Now, on to financing. So once you decide to build and buy these pods and deploy them, and you got site work and possibly purchasing land and all that, you can do a percentage of this capex spend per pod, which could include all those different things. How much of that is going to be financed with debt, like a regular loan? We do have an option for interest-only period, interest rate, and then the permanent loan will kick in after this 12 months period. You'll be paying interest during that 12 months period based on whatever rate you got. And then it switches to a permanent loan. You've got some closing costs that apply to the loan amount, and then other costs at close. It's just a hard-coded amount that hits on the launch month of each tranche, whatever is in here. You've got some notes, some helper calculation columns for other things going on in the model. You don't need to touch these, but do not delete them. Also, in general, don't delete rows. You can hide rows. Don't insert rows either. The dynamic calculations are tracking and calculating this going down. So if you start inserting or deleting rows, you're going to mess up all the logic. But you can hide them. Okay, so that's your build out. So you're kind of configuring all that. Now you've got a business going. Ongoing expenses here, you've got 2 sections for corporate overhead. You've got sales and marketing. The top section is going to allow you to put in initial annual cost. You can do growth of those costs, and you can see if I put in 10,000 here, and it's going to grow at whatever percentage I put in here per year. And you've got also some slots down here where you can manually define how much it is. It might not grow like with the rest of these, and that's fine. Excuse me. Wrong pipe. Oh, I hate when that happens. You can also put in the start month for each of these. So start month amount, and then over time, what do those costs look like? Same with G&A. So this would be things just to run the office, corporate overhead, not things that don't scale that really with the new pods. But keep the business afloat. You got administration. You might have some global sales and marketing things. You can account for that in these spots. You've also got some costs as a direct percentage of revenue, which you can configure here. And you've got fixed costs per month per pod. Now these are direct fixed costs, meaning every time you add more pods, these expenses start to kick in. And you've also got cost per member per month if you want to account for anything there. Now that might go with your ancillary revenue. If it does, you just want to make sure you're not double counting the costs. So you've got the cost here. You've also got the cost. You can do a cost of goods sold percentage on ancillary revenue. So just make sure these are not double counting, whatever they are representing when you input the data. You'll also have a cost per seat per month. Now per seat, and if we go here to look, here's your fixed direct costs. Here's your percentages based on total revenue. Here's your cost per member, so based on seats utilized, and here's your cost per pod based on total live pod. So I need to relabel that actually. So this is 79. This is cost per pod, sorry. Because seat and member are the same thing. Pod is different. And that's just a separate item compared to these, because you might have something you don't want to group here, or just put the rest down here, and that's fine. Now these, and you can see these costs are based on total live pods. In this one, where were we? Yeah, total live pods, so they're both. So it's just another slot to catch all. If you can't fit it all into here, that's fine. Just put the rest into this row. Then as we go down, you've got credit cards. That's just for ancillary income. And you can see here, you've got your credit card costs hitting here based on only ancillary revenue, which would be from the day pass users and the membership users. And that's everything for ongoing costs. You've also got one-time startup costs. This could be legal, consulting, just whatever. Not CapEx, so you won't put much CapEx here. Well, I guess you could technically. It's just going to hit in the first period, or period 0 right here in the model for as far as costs go. So then those are your main assumption tabs. Everything else is a summary. So monthly detail, you can see we've got all this data going across here. And if you adjust the model, say 60 months, whoops, all the data will stop at month 60. And I will go through more with what's going on with this investment, raising money and distributions and all that at the end. But I just want to get the core operations explained first. So we got all our revenue types here. Total revenue, some calculations for average revenue per pod, average revenue per utilized seat, direct costs. Oh, and keep in mind on the build out tranches, this price growth of 2% or whatever you put here, you can put 0, will apply to membership pricing as well as the day pass pricing and ancillary revenue. So that all will grow whatever percentage you put in here. So we have those direct costs, uh, gross profit, our overhead items, corporate overhead. Then we have got net operating income. And remember, here on the exit, you can do valuation based on an EBITDA multiple, revenue multiple, or an exit cap rate. And the reason why I chose 3 is really, you're selling membership, so it's kind of like a recurring revenue service. So you might want to value it based on a multiple of revenue or EBITDA, but it's also kind of like real estate because you're building, these properties or pods. People come and they pay a membership to access. So it's kind of like, it could be valued on a kind of like real estate. And in that case, you can put a cap rate here, and it will take the net operating income divided by this cap rate to get an exit value. So whatever you select, it'll use and give you the resulting figure there. um, Annual pro forma is same deal as the monthly, just showing the annual summary of all the data, which is sometimes nice to see. So you can see without scrolling anywhere to the right, you can see all of the information and financials. Sources and uses, we've got a detailed side and general side. This is what you see more in like a real estate model, but so I put it in here. It's got the dynamic calculation, so it's going to look at where your minimum cash position is, when that hits, and then up until that point, all of these different uses will go into the minimum equity requirement. So we have got that dynamic calculation going on. And so when you raise money, you can say, well, X is used for this, this, and some of these costs could happen over time until you get stabilized and profitable with a positive NOI. It's all as well as enough to cover your debt service. And then here's the money. Here's where the money's coming from to pay for all those things, equity, loans, and then possibly you might be using net operating income as well, um, depending on how your debt service and other capex things are going in financing. And then this is just the same data. We're just summarizing some of the rows to make it more condensed. Executive summary, similar to the pro forma, except for we have higher level items, so you can see this whole thing in 56 rows instead of on the annual pro forma you're at 160. So this is a bit easier to digest. You can actually see it all in one shot if you minimize the direct cost section. But same data, just presented a little bit differently. We have all these checks to make sure all the totals line up. Visualizations, we've got annual revenue by type, memberships, day pass, ancillary, annual gross profit, annual net operating income, cash flow, monthly cumulative. You can see where the break even is around, let's see, 25, 26, around 2 years, a little bit over 2 years. Debt service coverage ratio, which measures how well your net operating income is paying for your debt service, which is important. Average utilization rate, total debt balance over time, gross profit margin, annual net profit margin, average monthly revenue per active pod. And then investor distribution visuals here. We've also got operating account balance, average seats available versus used seats. So the difference of these two is going to be what defines this utilization rate. And then total live pods over time. And actually, I'd rather have this as a line chart. What am I doing here? Oh, chart design. Have I lost my mind here? Change chart type. There it is. I'd rather have that be a line. Okay, so that's pretty much all the model, how everything works on an operational level. We then have some other fancy things if you're doing a joint venture or, if you're a special GP raising money on a per deal basis and you want investors for this project, and you could just configure up to 4 different joint ventures. The first 2 are automated as far as the equity and distributions. The second 2 are IRR2 and preferred return. On these, you can see what the cash flows are of the project and cash requirements. And you could manually put in what your investment contributions are expected to be and when you distribute money out. And then it'll run through the waterfall logic and show, investor cash flow and owner operator or GP cash flow. And this is also where you'll see all the different GP fees hit if you have entered them, as well as the carry profit share happening in the initial contribution amounts. So preferred return, same thing as IRR2. You manually put in contribution distribution, runs through the logic, and then here's we got the LP and GP summaries here. You've also got IRR, equity multiple of each, and that'll be summarized on the front page as well. You could configure the contribution rate up top, how cash is split at different tiers, during pref, after pref, before equity is fully repaid, after pref and while repaying equity, and then after equity is repaid is this one. You could also do the rate here, if you're going to compound it or not, if you're going to clear out unpaid returns or not. Usually this is always no, because you'll be accruing, and also you'll mostly usually be reducing equity balance with profit share. Okay, IR2 is an IRR hurdle base. Now, both of these cash flows, the overlay cash flow that you're running this against is going to be the discounted cash flow analysis. And this looks at the monthly stream of cash flows from the pro forma, figures out where the minimum cash happens at and what that is. In this case, it'd be $1,031,000, and puts that up front. So that's upfront cash, and then shows the net distributions available after that. And so this is the basis for IRR2 and preferred return. There's also just a general, if you want to use this stream, but you don't want to get into the fancy hurdle rates or preferred return, you just want a straight this percentage split of contributions and distributions. You can use this, which discounted cash flow will be number 3, all cash up front. And here it's simple. How much is the investor contributing of that minimum cash of $1,031,000? As you can see up here. And how much is the GP or owner operator? And then what's the investor's distribution of available cash flow, and what's the owner operator's distribution? And then the summaries of those happening right down here. Now, number 1 is probably the best. I don't know the best. Everyone's different, but this is a pretty good way to do it. People like this style. So number 1, you can pick when you want to start distributions. So some month in the future after you're stabilized. You can define a minimum capital balance, so it won't distribute cash below that results in this going below $3 million. And then you can define right here on the monthly pro forma in rows 150, 151, what are the investor contributions, which can happen over time. They don't have to happen all up front, which will affect the returns calculated. And you'll see that on the monthly IRR tab over here, which we haven't looked at yet. But this runs off of that simple cash contributed and distributed. So this is all the equity coming in. Distributions can happen manually. You also have that automatic one happening, which we set in month 60, I believe. So you can see in month 60, we're starting distributions, but we're not reducing the operating balance below $3 million. And then finally, at exit, it will do whatever's remaining in the operating account plus that $3 million that's being held to get it all distributed out, and it's an exit at that point. And this is dynamic again, depending on the end month of the forecast period. And now this all fuels the monthly IRR and annual summary. These two are the two tabs before all these other tabs I just had gone over. So these are the first two in the joint venture summary section. And you can see same style. You got the LP, and you got the GP or sponsor here. And again, these are all mutually exclusive. So you can use one of them. You can analyze multiple at once, but they're all none of them are talking to each other. None of them are related to each other. You could hide the tabs you don't want to use. That's fine. I wouldn't recommend deleting tabs, but you could definitely hide them. Because some of them do reference the other just as far as cash flow streams, not any logic or anything, or developer fees or GP fees. But so that's what's going on there. And again, there's been a lot of time and effort going into figuring out what clients like the best in this style. The number one style, and that's why I put it at number one, is the most commonly used, where you've got, monthly cash flow from operations. Okay, well, based on that, what money do we need to raise and when? So if I zeroed this out, you can see, okay, our operating account balance is negative. And as we operate initially, before we get positive, we need cash. Eventually, we're going to get positive. So you don't have to raise it all up front. You could have 500,000, then maybe another 500,000, and eventually you get positive. Now that, again, this doesn't have to equal your minimum here of 1,016,000. It could be something else. But the idea is you're putting money in here so that your operating account balance never goes below zero. And then eventually you can distribute manually in row 151 or automatically based on these assumptions here. So the start month, that distribution start in the minimum equity you want to keep in the operating account, or minimum cash. And then it all runs from there. Now you can see how this is a little bit different, and obviously the discounted cash flow analysis style, where all equities up front calculated and then remaining distributions here, are different than the last two, where the last two you can see what the project needs, but you're manually adjusting this. So that means if you change the assumptions, change the exit cap rate, all that stuff, you want to come back over here and change the distribution, because those numbers are going to change. So if I'm looking at this, let's just say we're going to do a 60 month instead of 120. We don't even have to change any numbers besides that. Well, we come over here, and you can see obviously operations stop here, so we don't need this distribution happening in year 10. We go over here. Let's say we're going to ask for $1 million or raise $1 million between the GP and LP, and then no distribution to as we operate, and then year 5. Well, how much is left in the operating account? 26 million. So we could distribute all of that. 26,827, 290, and that zeroes it out, and that's a good number. And now we have updated IRRs and equity multiple. Same thing for IRR2. I'd come as put in here 26,827, 290. Okay, and there's those updated numbers. Now we also have, let's see what's going on with the monthly IRR. Oh, well, so here the fees are making it so the GP in this case barely has to contribute anything, so they're getting a really high IRR. If we zero out the fees, you see they come back down to earth. There we go. So now they're having to contribute their full percentage, and then they're going to split cash at the different IRR hurdles here based on what's available. So we've got two different IRR hurdle calculations, a monthly and annual. And this is only the second, probably the second model I've done that has both an IRR hurdle that shows annual cash flow. So again, based on all equity up front, and then future distributions on an annual basis. and then applying that to an annual IRR hurdle schedule, as well as a monthly view of that, where the calculations are a little bit different because it's monthly. So the IR, you're getting value for earlier cash flows, and then the timing of the cash flows will affect what the internal rate of return is for the LP. And on the annual basis, the monthlies don't, we're looking at only years, so there's less of an effect, but you can look at both scenarios and see which one you want to use. And as you use the model more, you'll get more comfortable with that. Okay, so if you want to download the template, it is available at smarthelping.com. Link is in the description below. I'm just making sure all these tabs are reset. You can go over to smarthelping.com. I will add this into the real estate section as well as the industry specific section. Now the real estate section, actually it's going to be in the general industry, real estate, and in the SaaS subscription, because this could be like a membership service as well. So it'll be in all three of these bundles, and again, you can buy the template individually. I think I'll sell it for a $75 one-time fee. So that'll be listed here when I finish, getting it posted and uploaded today, hopefully. You can also buy it in any of the bundles. So there's that bundle. The SaaS bundle is $289. It'll be in here, and the bundle includes all these other models I've built over the years. Industry-specific bundle. You can also hire me for work, $275 an hour. Remember the new option for PayPal. If you use it, it does have options for installment payments over time. You can email me for inquiries. Also, the Super Smart Bundle. If you just want to buy all of the templates on the entire site, you just pay a one-time fee of $500, which a lot of clients will do. And then you never have to buy another template again from me. In any work we do, I'll use the template if it makes sense. But a lot of clients will just buy this before they get started on work, because it's really so insignificant compared to my hourly rate that it just makes sense. Alrighty, well, I'm really happy about this model. Hopefully I'll have pick up the cadence. I really want to build more. It's just things have been crazy. I've been doing a lot of things, outside and just family stuff, and I've been doing a lot of billables as well this month and last month. So it's been busy, but I'll keep grinding, keep looking for new things to build. I like this idea because it's kind of like a business, a new business idea. The neighborhood co-working pods applied to a general old school model. Not old school, but real estate's been around forever. So it's taking two concepts, building the framework out. I like the utilization stuff here with the price elasticity. That's new for me to put in a model. So again, very interesting. You could start small. Could be for giant operations as well. Again, 60 tranches at arbitrary large numbers of pods, and this could be $1 billion business. It could be 100 million or 5 million or 1 million. So you can scale it as fast or slow and as big or small as you want, and just see what the economics look like. Alrighty, that's all I got. Like and subscribe. I'll see you on the next one.